we are going to discuss about valuation of goodwill. First of all, goodwill is an intangible but a real asset. Many factors influence the value of goodwill. So it is easy to describe but difficult to define. It represents the advantage of a business process because of good name, reputation, location and connection of a business. We can define goodwill is a present value of firm's anticipated excess earnings. Now let's move to the different method of valuation of goodwill. First one, we'll move to the average profit method. Under the average profit, the profit will be given for the different years. Okay, we have to add all the profit and divide by number of years. So the formula for average profit equal to total profit for all the years divided by number of years. Under this method, we have to calculate the value of goodwill. The value of goodwill under this method, average profit into years of purchase. We see the problem 1. Madan Mohan and company decided to purchase a business for rupees 1,80,000. Its profit for the last 4 years are 2011-12 rupees 40,000, 2012 and 13 rupees 50,000, 2013 and 14 56,000, and 2014 and 15 it is rupees 68,000. The business was looked after by the management. Remuneration from alternative employment, if not engaged in the business for the management, comes to rupees 3,500 per annum. Find out the amount of goodwill if it is valued on the basis of 3 years purchase of the average net profit for the last 4 years. Now we will solve the problem. They are given the various years profit there. 2011-12 40,000, 12-13 50,000, 13-14 56,000, 14-15 68,000. Total for 4 years profit it comes around 2,14,000. So we are going to calculate the average profit. 2,14,000 divided by number of years, 4 years they given. So it comes around 53,500. Less manual remuneration, the problem they given 3,500. So adjusted profit is 53,500 minus 3,500 equal to 50,000. So we are going to calculate the value of goodwill under the average profit method. So the value of goodwill equal to 50,000 into number of years of purchase, they given 3 years, it comes around 1,50,000. Next method we are going to see super profit method. Under the super profit method, we are going to calculate the goodwill. Super profit equal to average profit adjusted minus normal profit. So under the valuation of goodwill under this method, super profit into years of purchase. So now we are moving to the second problem. Average capital employed in X Limited is 30 lakhs, whereas net trading profit before tax for the last 3 years have been 14 lakh 60,000, 14 lakh 45,000 and 15 lakh 20,000. In these 3 years, the managing director was paid a salary of rupees 5,000 per month, but now he would be paid a salary of rupees 7,500 per month. Normal rate of return expected in the industry in which X Limited is engaged is 20%. Rate of tax is 50%. Calculate goodwill on the basis of 2 years purchase of the super profit. So we are going to calculate the profit now. So total trading profit for the last 3 years they given 14,60,000 plus 14,45,000 plus 15,20,000 equal to 44,25,000. So we are going to calculate the annual average trading profit 44,25,000 divided by 3 years. It comes around 14,75,000. Then we are going to deduct addition salary to managing director 7,500 minus 5,000. It comes around 2,500 into 12. It comes around 30,000. So altogether 14,45,000 minus income tax 50%. It comes around 7,22,500. So expected profit is 7,22,500. Then normal profit equal to 20% of 30 lakhs. It comes around 6 lakhs. Super profit, expected profit minus normal profit. That is 7,22,500 minus 6 lakhs. It comes around 1,22,500. Goodwill on the basis of 2 years purchase of super profit. So the super profit method, we are going to calculate the valuation of goodwill. 1,22,500 into 2, it comes around 2,45,000. The next method, we are going to calculate the goodwill under capitalization of average profit. Capitalized value of profit equal to profit adjusted divided by normal rate of return into 100. So under this method of valuation of goodwill equal to capitalized value of profit minus net tangible asset. We are moving to the next problem. The net profit of a company after providing for taxation for the past 5 years are rupees 42,000, 47,000, 45,000, 39,000 and 47,000. The capital employed in the business is 4 lakhs, on which a reasonable rate of return is 10% expected. Calculate the goodwill under capitalization of average profit method and capitalization of super profit method. First we will calculate the average profit. Total profit for the 5 years, that is 42,000 plus 47,000 plus 45,000 plus 39,000 plus 47,000 divided by 5 years. It comes around 2,20,000 divided by 5 comes around average profit is 44,000. Then capitalized value of the business is given the problem 10%. So 44,000 divided by 10 into 100, it comes around 4,40,000 minus capital employed. The problem they given 4 lakhs. So the valuation of goodwill will be 40,000. Then next method, average profit as above they given 44,000 we have already calculated, less normal return on capital employed, that is 10% in the problem they given. So 4 lakhs into 10%, it comes around 40,000. So super profit, average profit minus normal profit equal to, that is 44,000 minus 40,000 equal to 4,000. Capital value of super profit equal to 4,000 into 100 by 10. It comes around rupees 40,000. Then next we will move to the new method, annuity method. Average annual super profit into annuity rate. We will move to the annuity method problem. Calculate the value of goodwill for the following data on the basis of annuity method. In the problem they given average annual super profit is 5,000, rate of interest 10%, goodwill is to be valued at 3 years purchase of the average annual super profit. In case the problem there, we have to just we are giving a solution like this. In case goodwill is to be valued at 3 years purchase of the average annual super profit, reference will have to be made to the annuity table for finding out the present value of 1 rupee paid annually for 3 years at 10% interest. Reference to annuity table shows that 2.48685 rupees is the present value of an annuity of 1 for 3 years. The validity of goodwill therefore be ascertained as follows. 5,000 into 2.48685, it comes around 12,435 or 12,500. Next we move to the next sum. Balance sheet of Mr. X as on 31st March 2014 was as under. Liability side they given capital 2,50,000, creditors 80,000, bills payable 20,000. Altogether liability side total 3,50,000. Then next we see the asset side. Land they given 1,80,000. Then machinery 1,10,000, furniture 2,000, stock 8,000, cash at bank 50,000. Asset side total 3,50,000. The profit of the business for the 5 years ended 31st March 2014 are as follows. 31st March 2010 40,000, 2011 42,000, 2012 45,000, 2013 50,000, 2014 it is 53,000. The assets are revalued as under. Land 1,94,000, machinery 1,18,000, furniture 1,000.
The reasonable return on capital invested is 10% per annum. Assume that normal management remuneration is 6,000. Find out the goodwill by capitalization method. We know the formula, average profit equal to total profit of 5 years divided by 5. It comes around the total profit, that is 2,30,000 divided by 5 equal to 46,000. Then you deduct the remuneration 6,000. 46,000 minus 6,000 equal to 40,000. We are going to calculate the normal capital by capitalization of average profit method. So 40,000 into 100 by 10, it comes around 4 lakhs. Then the revalued land 1,94,000, machinery 1,18,000, furniture 1,000, stock 8,000, cash 15,000, total asset 3,71,000. Lease, liabilities, creditors 80,000, bills payable 20,000. It comes around 1 lakh. 3,71,000 minus 1 lakh, it is 2,71,000. That is the net asset or capital employed. Goodwill equal to normal capital minus actual capital employed. 4 lakh minus 2,71,000, it comes around 1,29,000. Capitalization of super profit equal to average profit 40,000 minus normal profit 10% on 2,71,000, that comes around 27,100. 40,000 minus 27,100, it comes around 12,900. So goodwill we are going to calculate under this method. 12,900 into 100 by 10 equal to 1,29,000. Next we will move to the next problem. Ram running a chemist shop. His net asset on 31st March 2014 amounted to rupees 20 lakh. After paying a rent of 20,000 a year and salary of 20,000 to the chemist, he earns a profit of rupees 1,50,000. His landlord, who happens to be an expert chemist, is interested in purchasing the shop. 12% is considered to be a reasonable return on capital employed. What can Ram expect as payment for goodwill? So we can just see the problem now. Okay, profit earned by Ram, in the problem they given 1,50,000. Add rent, no more to be paid 20,000. Add chemist salary, no more to be paid 20,000. Altogether 1,90,000. You deduct the reasonable remuneration for the new proprietor, assumed 25,000. So adjusted profit will be 1,65,000. So capital employed in the business, it comes around 20 lakhs. Add value of building, now form part of the capital, 2 lakhs. Altogether 22 lakhs. Normal profit at the rate of 12% the problem they given. 12% on 22 lakhs, it comes around 2,64,000. So adjusted profit is 1,65,000. Normal profit is 2,64,000. So there is no goodwill there. Under this method, okay, there is no goodwill at all. We will move to the next model. The following is a balance sheet of Sjctnc Company Limited as on 31st March 2014. Liabilities 3,000 equity shares of rupees 100 each, 3 lakhs. 1,500 8% preference share capital of 100 each, 1,50,000. General reserve 40,000. Profit and loss account 10,000. Bank loan 50,000. Sundry creditors 15,000. Altogether 5,65,000. Then we come to the asset side. Cash in hand 2,000. Cash at bank 20,000. Sundry debtors 80,000. Stock in trade 1,40,000. Land and building 2,05,000. Furniture 30,000. Goodwill 70,000. Discount on shares 18,000. Altogether 5,65,000. The value of asset is assessed as follows. Furniture to be depreciated by 10%. Value of stock in trade, land and building and goodwill is estimated at rupees 1,20,000 and 2,50,000 and 80,000 respectively. Debtors are expected to realize 80% of book value. Find out the value of equity shares. So we know the reserved value of realizable asset. Cash in hand 2,000. Cash at bank 20,000. Sundry debtors 64,000. Stock in trade 1,20,000. Land and building 2,05,000. Furniture 27,000. Goodwill 80,000. Altogether 5,63,000. Then deduct the liabilities. Bank loan 50,000. Sundry creditors 15,000. Altogether 65,000. 5,63,000 minus 65,000. We get the net asset 4,98,000. Then you deduct the preference share capital 1,50,000. Then asset backed up by equity share capital is 3,48,000. Number of equity shares is 3,000. So intrinsic value of each equity share is 3,48,000 divided by 3,000 equal to 116, that is 116.